A sneaky insurance agent just tried to sell one of my clients an Index Universal Life Policy, or IUL, instead of his whole life policy. And it would have cost him tens of thousands of dollars. Here's why. Let me show you how. Hello, my fellow Ripplers. This is Chris Miles, your cash flow expert and anti-financial advisor. This show is for you, especially if you want your money to work harder for you rather than you having to work so freaking hard for that money. You want to become work optional, where you work because you want to, not because you have to, because you have enough passive income to cover all of your family's needs. But it's not just to help create those selfish desires and have the nice boat or car or house or whatever it might be. No, it's because as you're blessed financially, you can create a ripple effect through the lives of others. And that is what it means to be a Rippler. Thank you for being a part of this movement. Thank you for being one of those that you might be even be one of these 1,000 families we're trying to help become work optional by the year 2030. So thank you for tuning in, binging, and sharing these episodes, because without it, we wouldn't be able to grow like we have for the last 11 and a half years, all because of you. Thank you so much. If this podcast has been of any benefit to you at all, please leave us a review. Please let us know if you thought this podcast is awesome. Also, if you haven't subscribed to our YouTube channel, do so today. All right, so let's just talk about that. And I don't really want to belabor this too much, but I'll tell you, I'm getting sick and freaking tired of all these social media influencers and stuff. Like, they're pitching this infinite banking, but it's using IULs, or Index Universal Life. It's getting worse and worse. And just so you're aware, even the grandfather of infinite banking, Nelson Nash, even said this was not meant for IUL yet. And I know I've already done a podcast on this just a few months ago, but I'm going to do it again because I want to show you the difference. Because, man, it blew my mind just how much of salesmanship this guy put in. I'll tell you, like, this is a client that I've spent hours with, I've known for years, and yet even he almost got duped. And I don't want the same thing to happen to you, whether you have a policy or not. I'm here to tell you that there are a lot of lying and deceiving that's going on out there, and I want to talk about why. So first and foremost, I want to address kind of how this guy sold it, right? Because it wasn't just the numbers. In fact, I had to ask for the numbers. The thing that was really getting my client here is that this guy was using everything in the book. And here's what's crazy, guys. Like, so he starts listing out, like, this insurance agent starts listing out 7 points, right? So here are the 7 points he starts saying that is the benefit of an Index Universal Life Policy, or IUL. Now, a lot of this could apply to VUL, Variable Universal Life, where the stock markets are related to this. Just so you're aware, if you're not sure what universal life is like buy term and invest the difference in one. You get this renewable 1-year term plan that's inside of it. It is permanent insurance. They will confuse it with whole life insurance because they're both considered permanent insurance, where term life insurance is temporary, right? It's only good for 10, 15, 20, 30 years. And then after that time, if you don't renew, it cancels on you, right? The term is done. I often refer to that as death insurance. Tom Wheelwright, who's the CPA for the Rich Dad Poor Dad book, says that term insurance is an expense. Whole life insurance is an asset, right? So there's term insurance and there's permanent insurance. So in the permanent insurance buckets, right, or that bucket there, that category, you've got universal life and whole life. That's pretty much it. Now, universal life has like variable universal life, where yes, it does have the insurance component too, but it also allows you to invest in the stock market. So you're actually investing in mutual fund type of funds or accounts. They call them sub-accounts. Index Universal Life came to be more popular. In fact, I know because I sold both of these types. I sold Variable Universal Life in the early 2000s, but then when Y2K hit, a lot of people got burned in the market. By the way, I saw a lot of people lose their insurance policies because the cash was getting eaten alive by the market losses. And so people had to, if they wanted to keep this insurance in place, they had to pump more money in. So I'm not going to focus on Variable Universal Life because that one I just don't like very much, even though it's become more popular the last 10 years, 5 or 10 years, because the market's been straight up for 16 years, right? So that's one reason. But Index Universal Life became popular in the mid 2000s, or more popular. It became more popular now, more into the 2020s. Index Universal Life says there's a cap to how much you can earn in the market, but there's also a floor. So if the market ever goes negative, they'll still tie it to like the S&P 500, but the stock market goes negative, it might only hit down to like 0 or 1%. So even if people lose 20% in the stock market, in this indexed type of fund, it'll bottom out around 0 or 1%, which sounds great, right? By the way, for me, by 2005, I was really starting to sell those more than VULs instead. Um, Now there's also a cap. They'll put the cap on whatever they think is suitable for the insurance company, not so much for the client. So right now you see the caps around 8, maybe 10% at most. So that means if the stock market hits 25% in a year, you get that 8 or 10% cap. You hit the cap. Now, if the market does 5, you get 5. If it does 3, you get 3. You get 8, you get 8, or whatever, below the cap. But it always hits the cap, has a ceiling and a floor, right? It's almost like having a W-2 job, right? Like it's safer than trying to be an entrepreneur where you can have unlimited income potential. You know that you have limited income potential as an employee, but you also know at least you have a salary, right? That's kind of what it's like. So, anyways, so with these universal life plans, right? The thing is that there's a few things that are a little bit different than whole life insurance. For example, like I said, these are term insurance policies that renew every year. So every year you get older, what do you think happens to those term insurance costs? Those insurance costs go up, right? Because every year you get older, you're more likely to die. So the costs go up each year. This is different than whole life. Whole life insurance is front loaded with those insurance costs in the beginning, but then they drastically back off about years 3, 4, and beyond. So it actually, the costs go down over time, where universal life, the costs go up over time. And just like, I mean, both of these get sold for a lot of people, not just insurance, but get sold as like, like a supplemental retirement account, right? Yes, you can create tax-free income and all that kind of stuff, and I'll get into that in a bit. But ultimately, that's the main difference. Now, there's another difference too with universal life, is that they have surrender fees. So in the beginning, especially, and I'll show you what that looks like, but in the beginning, you actually don't have full access to your cash, unlike whole life where you do. And again, because there's the uncertainty of the returns you get in the market, also there's the uncertainty of as the costs go up. Because of the uncertainty of the market returns, the cost going up could actually deplete your returns. And I've watched a lot of people come to us. Some of you, in fact, watching this right now, come to us saying, "I have one of these universal life policies, and I'm watching the cash eat itself alive," especially as you get my 50s, 60s, or even 70s. And so people are watching these things run out of money because they didn't return as big as they promised. That's the one thing I saw consistently over time, the last couple of decades with any kind of universal life policy. It's been overpromise, underdeliver. And so there's been a lot of people upset. But now, because the stock market has been going straight up, nobody's worrying about that right now, are they? They're like, "Oh, it's fine." I tell people all the time, I would get index universal life if the market was at a bottom right now. If we saw a market crash, I would consider getting a small policy. And that's what I told this guy. So anyways, enough about that. I've explained that in other episodes before, but I just want to give you that basis in case you're just tuning in for the first time. Here's the thing the guy said. He's like, "Here's 7 benefits you get with my special index universal life plan," right? So number 1, capital preservation by having the guaranteed floor, protecting your principal and growth at all times. So remember, he talked about that floor, right? And whatever that floor is at 0 or 1%, which is pretty typical. By the way, the insurance companies can change the floor rates at any time. They won't go below 0, but they can change it. They can also change those cap rates. Just understand, when I sold universal life 20 years ago, there was companies that had a 17% cap, 12% caps. You don't see that anymore. You really don't, because it was way too high. And now they've come back down. Even though the stock market has been doing great, you haven't been getting as good returns. So all those illustrations I sent out saying you'll make 8, 9% a year average on this thing, nope, not anymore. They don't have been making 6%, so that's an issue. So he's saying you get a guaranteed floor protecting your principal and growth at all times. But as I mentioned, imagine this. Imagine you have a 0% return on your money, on your cash. Well, you still have insurance costs coming out of that bucket. There's a hole in this bucket, and that hole gets bigger every year as you get older. And so you've got to make sure you have massive returns, because if you don't, it just keeps leaking away. So even though you might earn 0%, you might not lose money on the return. Still, you'll lose money because the insurance costs are coming out and they're increasing every year. So you get 2 down years in the market, although you don't lose money from the market returns, you are losing money because it's pulling it out. So you have to keep pumping money into this to help keep that bucket full. That's one problem right there. So when he says guarantee your principal and growth at all times, not 100% true. Number 2, he says, provide a permanent life insurance with living benefits, which is utilized to protect your assets, your family from financial harm, and of course, your income while you're still alive. Okay, guess what else has that? Whole life insurance. Same living benefits. He's talking about things like you can actually have access. Well, he actually mentioned some of these too. He goes to explain. Here's the first one: long-term care. You provide long-term care without wasting expensive premiums and other standalone products. So long-term care. Here's the difference, though. Long-term care insurance just says that if you're ever put into a home or you need home health care or anything like that, you have to provide an income stream to help pay for those things. Because I'll tell you, I mean, I'm looking at my dad with 24/7 healthcare. He's paying about $6,000 a month for that healthcare right now, just to keep him alive, right? So you have that kind of stuff, assisted living and those sort of things. So long-term care helps cover that. So he's saying, hey, you don't have to worry about buying long-term care insurance. You can just use this. What he's not explaining, and I didn't even explain this to my client yet, but what he's not explaining is that it actually is a limited long-term care policy. They usually only cover, say, like 5, 10 years or a certain percent or a certain amount of money, and then it's gone. So that's one thing they don't always say. I actually have an opinion you should have a separate long-term care policy and get this policy and not pay the extra for the long-term care. And he says, oh, by the way, it's also automatically included if qualified. What he didn't say is it is automatically going to charge you more costs too, which just makes that leaky hole bigger. 4, he says, protect your income during your working years in the event of critical illness or injury. So basically for in case of disability. Guess what? Whole Life has the same thing. And what's nice is at least with some of the ones we use, they actually don't charge you for that same benefit. I'll give you an example. Like if someone gets $1 million death benefit policy, if they become disabled, they're allowed to access $250,000 of the death benefit. So they can actually use the $250,000 of death benefit to help them through that disability or whatever it might be. Now, there's different ways to do it, and there's different percentages or different whatever, but with different companies. But that's just an example, right? Like you can get access to that death benefit while you're alive. That is a cool feature. But guess what? Whole Life offers that, just like the Index Universal Life, as he's claiming. And the cool thing is, the Whole Life, you don't have to pay for it. It's just automatically included at no cost. There's also another one too he didn't mention. There's accelerated death benefit, which says that if you become terminally ill, like if you have 12 months or less to live, you can actually access up to 50%, half of your death benefit while you're alive. So you don't have to wait till you're dead. You can actually access that money now. All right, let's go to his number 5 is provide your family a significant inheritance tax-free. Guess what else that applies to? All life insurance, even term life insurance provides a benefit tax-free. But thanks, that's a good benefit for sure. Number 6, have continued uninterrupted tax-free compounding growth to your funds even after age 63, or whatever age you choose to stop contributions. Remember, you can speed up this process and front load more and continue to contribute past the design based on IRS guidelines. Now, here's what's interesting. So he's saying like you have uninterrupted tax-free compounding growth to your funds even after age 63. That's right. And yes, you can decide when to do those contributions. Guess what? That's also a benefit of Whole Life. You can do exactly the same things. Now, I will warn you against the front loading, like throwing in extra money up front. It does, as you said, the IRS guidelines, it does require you to have a bigger death benefit, which means more costs. So we often will discourage people from doing a very big amount of dumping up front. You might do a little extra in those first years if you want to, but we usually try to teach you, hey, that does increase the costs. Your ROI can be better if you do this or this instead. But he does say, hey, you should put in more. Why does he say that? Because guess what? Life insurance agents get paid the most in the first year. That's why they say it. So of course, if it increases your costs, it increases their pay, their commissions. That's why he's saying it. Again, he makes it sound amazing, like uninterrupted compounding tax-free interest. Well, that's not always the case. Like I said, with his IUL, if again, it doesn't return anything because you don't really make any money or very little interest because the market went down, you could actually lose money unless you keep pumping more money in. So not totally true. And then the last one, tax-free access without penalties and restrictions and without impacting your principal that is continuing to grow and compound. So it means you can leverage your cash value outside of your policy without impacting internal growth and momentum. Let me just say what this is. He's saying you can access your money at any time, tax-free. You're not paying taxes when you pull it out. That is a great benefit of all life insurance, Whole Life and Universal Life. And then he's saying it doesn't even have to impact your principal as continuing to compound and grow. He's saying like you can actually leverage your cash outside of your policy and it still keeps growing. Now, that's not always true. In fact, with most universal life policies, if you borrow from the cash value, this is different than Whole Life. If you borrow from the cash value, they will credit you interest to match the interest rate at best. It's called a wash loan, where say that it's a 6% loan rate, but they'll credit you 6% to make it a 0% net loan. But they're not compounding your growth. That does happen in maybe about 5% of index universal life policies. It's very rare. I mean, it's there, it's available, but it's not as common. And often they'll do different things to manipulate the numbers or make it more expensive if you do choose that option. If you've been following this podcast, you're probably looking for great ways to create passive income right now, right? Well, we got you covered here with Central Lending. Central Lending specializes in alternative investments that actually are designed to create steady returns and long-term financial security for you and your family. Now, they prioritize transparency. They love, building those strong relationships, giving you that confidence and peace of mind, knowing that you have your money working harder for you, so you don't have to work so hard for that money. You want to learn more how to do that? Go to centrallending.com and check out what they've got today to create your passive income and wealth creation right now. So just so you're aware, Index Universal Life does not allow you to make money in two places at the same time. Often what will happen is you'll have a 0% net growth, because the loan will be canceled out by the returns, right? So it'll be a 0% loan, but 0% growth. While you can, yes, invest your money outside of the policy. That's true. But with Whole Life, the great thing is that they charge you, they do it separate. When they lend you their money, they're not crediting to your interest. They're paying interest on all the money that's in there, tax-free compounding interest. They're paying your money the whole time. When you borrow the money, you're just paying them interest based on the amount of money you do. And of course, if you use it to pay back with returns and things like that, that's better. So with Whole Life, you can actually double dip, making money in two places at once. Universal Life, maybe 5% of the time. So that was one of those benefits that weren't great. Now he goes into using different terms, talking about things like using a LIRP, LIRP, life insurance retirement plan, which is just a fancy name for life insurance, and using it for retirement. All right. So they start throwing out those little terms, principal guarantee, tax-free growth, and tax-free access. Principal guarantee to an extent, as long as you don't lose money from the costs. He also said that he's like, by the way, you got to prove the highest health rating available. I hardly ever see that happen. BS. The guy got the highest health rating with us already, and a lot of our clients get that highest health rating. So I'm not saying that everybody gets it, but he made it sound like almost no one gets it, in my opinion. From my experience. Okay, now he's just stroking this guy's ego, saying you got to do it now. Don't miss out. I apologize if you're watching this now. The sun's shining right through my eyeballs right now, so you're getting this extra bright, Chris. The light shining. Okay. He also says, remember IRS code. The IRS code 7702 allows you to be able to have zero taxes. The IRS code 7702, which some people call them 7702 plans, like 401k plans, is just taxation for life insurance, all life insurance. So he's just talking about all this stuff and living guarantee, guaranteed floor. I mean, he's making it sound amazing. Now, this should be the best thing since sliced bread, right? But at the end of the day, I asked the client, it's like, well, did he send you numbers? What do the numbers look like? Let's see that. All right, so here you go. Now, to avoid some of the confusion, and you'll see this, if you ever get stuff from Index Universal Life, it looks something like this. Now, they're showing you the guarantee. So it says minimum account value is 2%. So it's showing here, it might get a 2% floor. That could be cool, all right? If you can get 2% floor, again, they can always change the floors at any time. So even if it's 2% today, that might change tomorrow. But it's showing here's 2%. Now, there's a 4.5% one right there. Whoops, zoom in just a little bit more so you can see it. And then there's the 6.58%. Oh, that was the other thing too that kind of made me laugh. He said it's a conservative 6.58%. I will tell you my experience, most IULs have not performed that well over time. Short period of time, yes. Longer term, not so much. And especially, remember this, I've mentioned this many times in the podcast, Vanguard had mentioned expects the S&P 500 to only do between 2.8 and 4.8% a year for the next 10 years. And do the math, that's like worse than a CD. So I told my client, I said, listen, the 4.5%, this middle column is likely the one to look at. But even if we look at the one on the right, you'll find out that that's not even that great. So let's look at this. Let's look at the value here on the right. The one in the middle, the one right in the middle, the 4.5%. So he puts in 18,000 a year. That's what it shows him doing. Now you'll see the account value is almost 15,000. That sounds really good, right? However, the net cash surrender value is $1,100. So these surrender fees I talked about, the surrender fee just means how much access you have to cash. The difference with universal life is insurance companies love it. By the way, I work with insurance companies that we get whole life through, but they're pushing more to get universal life, variable universal life, and an index universal life. In fact, in the last year, more people have been getting these. More financial advisors have been selling these than even whole life because people have no longer spooked by the S&P 500, which is exactly the time you should be spooked. When people stop being spooked by the market return, especially when they're so high, that's when you know we're about ready for a big correction in the market. So anyways, but the actual cash you have access to is only $1,100. So you put in 18 grand to have access to 1,100. See, with whole life, there is no surrender fee. What you see is what you get. It's simple. It's very easy. If someone would put in that same 18,000, I'll show you what the difference is because I showed it with his own example. It's much higher, right? It's much, much higher. It's similar to what his account value is on that left side of that middle section, but you actually have access to it. Now, notice the next year, although the account value did grow by a little bit, not by the same amount he paid in, still he has access to 17,000. So he has access to less than half what he's paid in. He's paid in 36,000. The next year, he's got 33,000 available, right? And notice that the surrender fees do drop each year. This is why there's going to be a less of a spread between these two numbers. But look, I mean, even after 5 years, he's paid in 18,000 a year. That's $90,000. He's got just under 70,000 there. 80,000, 79,000 the account, just about 70,000 actually available. Notice the death benefit's the same. It's 341,000 the whole way, right? That's another thing too. So notice it's not growing. So even after 9 years of paying in, that's 162,000 he paid in. After 9 years, he still only has 149,888. We'll just round up to 150,000. He paid 162 to only have 150,000. He never even broke even. But remember, this guy sold it like it was the best thing on the planet, way better than any whole life policy he's had. I guarantee he didn't say, hey, apples to apples, here's what it looks like, because this guy was only paying in 15,000 a year. So again, like, he's talking this up like it's so amazing. Now, even if I go on the right-hand side, the one that's really a speculative return, I do not expect him to get over the next 10 years because even the stock market professionals don't think you'll get that. Still, 9 years, 168,000. So even then, even at that point, he still doesn't even have, he barely has just barely over what he paid into it. This is way different than whole life policies where you have more than that. Now, I'll show you this. What happens if you get the guaranteed? Now, I'll say this. I don't believe people will get the guaranteed. I think they'll get closer to the non-guaranteed alternate than they will get to the assumed, and definitely not the guaranteed, because the market would have to go down every year for you to get that 2% minimum in this case. But watch. If I scroll down here, one thing that starts happening is you'll notice that this cash value goes up to about 114,000 year 9, and he stops funding it and it starts depleting because, again, the market returns aren't there. Remember what I said, if you're not contributing to it, it starts losing because of so even though it has interest being earned, the costs are still higher and starts eating into it. I'm not even showing you the next years. It eventually does lapse once you get to roughly about your 70s, and then it's gone. On this one, however, it takes a little bit longer. Now, the one in the middle, it did actually keep growing even into the older years, just not a ton. In fact, it was about half. When you get to the later years, about half of what you would get on the right-hand side if you happen to get that 6.58% conservative return, which it's not. Because I'll tell you, I have plenty of friends that do run IUL illustrations that say, yeah, I don't know if I would trust 6.5% because you just don't know. And it's true because, again, things have changed so much, right? So anyways, but still, that's what he has. So remember this. In the mid-range example, he would have just about 150,000, maybe 168,000 if you're lucky. How about ours? How does ours compare? Now in this one, like I said, he only could do the max of 15,000 a year, but he also had a loan outstanding. He'd already been using some of the money to invest and do things. So I told him, I said, here's what you're going to do. You're going to still keep paying the 15,000 max, which, by the way, he had freedom to keep doing. Some reason he was under the impression he had to pay it for his whole life, which is traditional whole life. But we actually showed him only paying it to his mid 60s and then stopping forever because we don't worry about that. Now, with that being said, I said, all right, so you have about 10,000 in cash, net cash that's in there that you haven't leveraged or borrowed, but you do have a loan. So why don't you pay 3,000 a year towards a loan? So that's 18,000 total, just like this guy showed. Now you can already see year 1, right? The first year, which is really like year 6 on this, you'll see he's already got $28,000. Now take away the 10,000, of course. Take away the 10,000 that was already in there in the first place to make this more apples to apples, because that guy started from 0. This one starts from about 10,000, but still $28,000. Now a lot of this is because he's gotten past the initial cost, but still I mean, he's paid into this now for 5 years, and and even though he didn't max fund every year, the crazy thing is he has almost exactly the amount of cash he's paid into it. So where the other one, it took him 9 years in the more speculative example. He didn't even do it in the mid range, but in the speculative example, he finally surpassed it by the ninth year. Here on ours, it usually does about the fifth, right? Especially if you max fund it like the way we show you. Well, in this case, again, we're starting from 10,000, still 28,000. That's still 18,000 versus 1,100. Way better. And he has access to that money. The next year, he's got 47,000. Remember, the other one had 17,000. So we still have $30,000 more in that next year. Where's the advantage? You go out to the 9 years, age 64 there, right? The 9 years, he's got $212,000. You'll see that right here where my arrow is pointing. 212,000. That's where I'm getting these numbers from, is this column. 212,000. This is based on 6% dividend rate, which it's been right now. By the way, just so you know, the last 20 years has been between 5.75 and 6.34. So there's not as big of a range. There's not all this uncertainty of, is the stock market going to go up or down? It's not tied to that. It's tied to interest rates. So right now it's at 6 because now we start to see the rates start to go up, right? If rates stay higher for longer, this could actually go up to like 6.5%, which even at 6%, this is kicking the crap out of the 6.5% one because again, the costs don't go up, they go down instead. And so 212,000. The other one, even with the higher interest rate, was still at 169,000. So he was way less. I said, even if you take out the 10,000, you're still $34,000 ahead of the game on that better example. Even on the other one, the worst example, I mean, you're even roughly about $40,000 or $50,000 ahead. And by the way, remember that other one had a death benefit of like 340,000. Ours is like over 600,000. It started just a little bit higher and it kept going up. So he actually has a higher death benefit and higher cash value. And so my question to him is the same thing I would ask you. Where's the benefit? Why would I do that IUL? It's supposed to be the best thing on the planet, right? And hey, apparently you could do infinite banking with it. Although, as I just said, you don't because you can't make money in two places at once necessarily. Yes, you can run your money through it. And yeah, you can use it to pay off credit cards and do different stuff, but not in the same advantage that you get with whole life, like we always talk about. You don't get those benefits with IULs or VULs for that matter. In fact, and just so you know, banks don't even like IULs that much because they will maybe limit you to 50% access. If you want to borrow from using a bank to do a bank line of credit against your indexed universal life policy, they might only give you access to 50% because of all that variability and the higher costs. Oh, they also didn't show what happens when you start pulling out income in retirement. That's the thing that gets scary in an IUL because, as I already mentioned, it's not growing nearly as fast as it may want to. And if you start pulling out income, it could actually start losing money. Where this, we can pull out income and have it last forever. And so get that tax-free income. So long story short, needless to say, I just told this client, where's your benefit? Where's this amazing thing that you've been sold that this is better than whole life, better than anything else on the planet out there? Where is it? Because it looks like a piece of crap. And that's what happens, guys. When it comes down to it, if you can really compare apples to apples, really down to the numbers, you'll start to realize there's a lot of fluff out there. There's a lot of stuff on social media that says that IULs are better. And especially for infinite banking, they're even saying that it's IULs. We even had real estate investors say, oh, you do infinite banking, so you sell IULs? No, it's not. But there are a lot of influencers who don't know otherwise because most of these influencers are under the age of 40. They've never seen a down market. 2022 to them was a blip. That one down year out of the last 16 since 2009, that's all they've seen. And so, of course, they say, oh, IUL is great. It's best. But is it really? Whole life might seem boring, but man, it's sure. I think boring is sexy. That's what my wife says at least. But it's true because you want to make sure you get certain money and if it can return even better based on being very designed. Remember, this is not normal whole life that we do. It's the max ROI guaranteed to give you the best every single time. No one else will beat our whole life policies. They might match it in less than 1% of cases we see when we see comparisons. Someone might match it, but almost every single time they don't. They don't beat it, and they definitely rarely ever match it because we cut down this cost as low as we can. I've spent the last 20 years figuring out how to do it to where we got it down to a science so that you get the best ROI possible, which is why we call it max ROI infinite banking. And so again, if you ever have a question on that, you can always go to our website, moneyripples.com/infinite-banking, or just the infinite banking tab. You can go there. We've got stuff on that. But I'll tell you this, is that you've got to be so careful. There are so many snakes, oil salesmen out there trying to sell you crap, bad actors, bad people that are trying to sell you on this. And they believe it. They drink the Kool-Aid. They think it's actually real, But in truth, they're really just trying to sell you something. You got to always come back to what's your life look like? Are you just making money off the sales, or is this thing actually working for you where you have mass amounts of money and you're able to invest and do things to create passive income? Because if you can't do that, then don't talk to me. And that's the truth. This is actually the way you can do it. Max ROI Infinite Banking is the way. Index Universal Life is not. Stay away from those IULs and VULs. Like I said, there is a proper time to do it. We can even do it ourselves. We can actually give you an IUL, yet we choose not to because we know better. We know we've seen the apples to apples comparison. And every time IULs just disappoint and create more risk, more uncertainty, and you don't need more uncertainty in your life. There's plenty in the world right now. You need more certainty so you can make more passive income. And there is where more freedom is possible. So go and make it a wonderful and prosperous week. We'll see you later.